emerging versus developed markets from an investor perspective. This is your worst podcast host, Andrew Stotz, and I am here to talk about emerging markets. There's 5 topics that we're going to cover. I'm going to introduce emerging markets, introduce our FVMR framework, talk about fundamentals and valuation, and then I'll show you my asset class and region country allocations. The emerging markets I'm looking at in Europe are Czech Republic, Hungary, Poland, Greece, Russia, and Turkey. In Asia, it's China, India, Indonesia, Korea, Malaysia, Philippines, Taiwan, Thailand, and Vietnam. Latin America, it's Brazil, Chile, Colombia, Mexico, Peru, and in Africa, Middle East, it's Egypt, Morocco, and South Africa. Vietnam, it's actually not an emerging market, it's a frontier market. Some of you may be surprised to see that Korea and Taiwan, you may have thought that they were developed markets, but because there are some restrictions for investing, MSCI keeps them in the emerging market. So my FVMR framework starts with management. Management's responsible for producing earnings. The next part of it is price, and that is the responsibility of investors. They're setting the price based upon their trades. There are 4 elements to our FVMR framework. First, fundamental, looking for strong profitability, which shows that a company is managed well. And we prefer high or rising profitability. So the second one is V, valuation, which shows how the market perceives the stock. And we prefer good fundamentals at relatively cheap prices. Then there's momentum in both earnings and price, and risk in both earnings and price. So now let's get into it and start with fundamentals. And the conclusion that I've made is that emerging markets are about 20% less profitable than developed markets. The EBITDA margin for the world is at about 19%, and it's 17.5% for emerging markets. That's about 10% lower in emerging markets. What about net margin? Well, that's 32% lower in emerging markets. The world is earning a 10% net margin, and the emerging world is earning a 7% net margin. Why is the world so high? The long-term average I've calculated in my past is about 6%. So already the world is at a super high level of net margin, and that's driven particularly by the US. Let's look at return on equity, which is 23% lower in emerging markets. Return on equity in the world is at about 15%, and in emerging markets, it's at about 12%. Let's go down and look at a country basis to understand the best and the worst from a country perspective. So the most profitable countries are Indonesia, Australia, Philippines, US, and UK. And the least profitable are China, Korea, Thailand, Japan, Germany. So let's look at valuation. Emerging markets are about 40% cheaper than developed markets, or than overall market. Emerging markets are at a 50% discount on price to sales. The world price to sales ratio is about 2 times, and it's 1 time for emerging world. That's cheap. Let's look at price to EBITDA. They're at a 44% discount. So on a price to EBITDA basis, the world is trading at 10 times, and the emerging world is trading at 5.6. Incredible discount. And what about price to earnings? Well, that's a 26% discount. In other words, emerging world is trading at 14%, whereas the total world is trading at 19% price to earnings. And finally, there's price to book. There's a 43% discount. It's incredible, about half. Emerging world is trading on only 1.6 times price to book versus the world at 2.9. Cheapest countries are Italy, Germany, UK, Korea, and Hong Kong. And most expensive are India, US, Taiwan, Australia, and Singapore. First, UK. It's cheap and highly profitable. So that is the only country that meets both of those criteria. Germany and Korea are cheap and they have low profitability. And Australia and US are expensive, but they have high profitability. In other words, they have earned their high multiple. Finally, I'm going to talk about my asset class and region country allocations. Remember, this is not a recommendation, and my next rebalance is in September, and everything that I'm talking about right now could change. Right now, I have a 65% allocation to stocks, 5% to bonds, 5% to commodities, and 25% to gold. You can see my confidence in gold is pretty high. Again, let's continue on and look at regions and countries. Remember, I said that I'm 65% exposed to equities, so where is that exposure? US is only 5% of that 65. Developed Europe right now is at 25%, Japan is at 5%, emerging markets 0%, and Asia Pacific 3x, which is Asia Pacific ex-Japan, ex-China, and ex-Hong Kong. is at 25%, and finally China is at 5%. These are my latest allocations, but they're going to change in about a month or so. Use them as a guide, use them as research, but don't use them as a recommendation. So that wraps up that emerging markets are hurting, but they're cheap. This is your worst podcast host, Andrew Stott, saying, I'll see you on the upside.